The festive season is here, and along with it comes something many employees eagerly wait for, the festive bonus. While it's tempting to splurge it all, a smarter approach is to use at least a portion of your bonus to strengthen your financial future. Hello everyone, welcome back to the channel. In this video, let's discover simple, powerful strategies to spend and save your bonus, turning a windfall into lasting financial freedom. First, build your emergency fund. Aim to save at least 6 months of essential expenses and even 12 months during uncertain times. Without this safety net, you might be forced into high-interest loans or selling investments at the wrong time. Essentially, your emergency fund needs to keep up with two things. Lifestyle inflation. Did you move to a bigger place? Buy a more expensive car? Take on a larger mortgage payment? Every time your essential monthly bills increase, you must top up your emergency fund to ensure it still covers 6 to 12 months of that new, higher expense level. Even if your lifestyle hasn't changed, the cost of groceries, gas, and utilities certainly has. Because your money buys less over time, you need more cash in your fund just to maintain the same level of coverage. Your action step. Review your fund and current monthly expenses at least once a year to make sure the number is still accurate. Don't let your 6-month fund quietly shrink to a 4-month fund. Next, prepaying loans to accelerate your freedom. Once your emergency fund is solid, the next best use for any extra cash, like a bonus, tax refund, or sudden windfall, is to aggressively prepay high-interest, long-tenure loans, like personal loans or home loans. Every rupee you put toward the principal balance now works like a financial time machine. You save massive interest. When you prepay, you're reducing the amount of money the lender uses to calculate future interest. Because interest compounds over many years, a lump sum payment today translates into thousands of rupees saved over the loan's lifetime. The power of tenure reduction. When you make a prepayment, your lender will typically offer two options. First, reduce your EMI or monthly payment. This frees up cash flow now, but you don't save as much on total interest. Second, reduce the tenure. This is the gold standard. By choosing this, your monthly EMI stays the same, but the final payment date moves dramatically closer. This focuses the savings entirely on cutting the total interest you'll pay, significantly speeding up your debt-free date. Always prioritize prepaying loans based on their interest rate, tackling the highest ones first. This is often called the debt avalanche method. Use that bonus money not just to feel good for a day, but to gain financial freedom years sooner. Once the emergency fund is full and high-cost debt is managed, your bonus cash should go toward proper insurance coverage. Think of insurance as the firewall that protects your entire financial plan, your savings, investments, and assets. Go simple, go term. Forget those complicated life insurance policies that mix saving and insurance, like endowment or ULIPs. They are expensive and often inefficient. A term life plan is pure, cheap protection. You pay a low premium, and if the worst happens, your family gets a large, tax-free lump sum. The payout should be enough to replace your income and cover all major expenses, mortgage, education, daily living for at least 10 to 15 years. This ensures your dependent's lifestyle remains secure, even if you are not there. The biggest threat, with medical costs skyrocketing, we call it medical inflation. A single hospitalization can wipe out a decade's worth of savings or your entire emergency fund. A robust health insurance, or Mediclaim, policy shifts that massive, unpredictable cost risk to the insurer. Your annual premium is a small, predictable expense that shields your wealth. If your current coverage is inadequate, topping up your insurance with a bonus is the single best way to protect all the other financial goals you've worked so hard for. The best time to buy coverage is when you are young and healthy, because it gets exponentially more expensive later. The next priority is earmarking funds for specific, short-term goals, for example, a down payment in 3 years, a vacation in 18 months. Since you cannot risk this capital, you need fixed income investments that prioritize safety and liquidity over high growth. The safe bet, FDs are a time-tested tool for capital protection. They offer guaranteed returns for a fixed tenure. Finally, if you have covered your short-term needs, your bonus is prime for long-term investment. While a systematic investment plan, SIP, is excellent for monthly income, a one-time bonus presents a unique choice. Option 1. SIP out. Instead of investing the entire bonus immediately, you can move the entire amount into a liquid fund first. Then, set up a systematic transfer plan to automatically transfer a fixed amount from the liquid fund into your chosen equity mutual fund over the next 6 to 12 months. This allows you to avoid the stress of market timing. By staggering your investment, you smooth out the purchase price, insulating yourself from the risk of investing all your money just before a market dip. Benefit from rupee cost averaging. You buy more units when prices are low and fewer when prices are high, lowering your average cost per unit over time. Option 2. Lump sum. If the markets have recently corrected, are at a relative low, and you have a very high risk tolerance, you could invest the entire bonus in one go. Historically, lump sum can yield higher returns if timed perfectly, but the risk of mistiming the market is significant. By using your bonus to fund a long-term, disciplined investment plan like an STP or SIP out, you harness the wealth-creating potential of the market while mitigating short-term volatility. So yes, enjoy your bonus, you've earned it. But also use a smart portion of it to secure your future, reduce debt, and build wealth. That way, your festive bonus will keep rewarding you long after the celebrations are over. Don't forget to like, share, and subscribe for more personal finance tips.